Okay, this is for week 3 Thursday class. So we finished the second chapter. We basically talked about efficient portfolio, efficient frontier, and after talking about these two things, we introduced this capital asset pricing model, which based on the assumption that the market portfolio is the efficient portfolio. So now let's summarize this chapter by using this chapter review. So first, how do you calculate a portfolio's return? Well, the first step to answer this is you want to first find out portfolio weights, right? So let's say your portfolio has two stocks, right? Stock 1 and stock 2. Now, to calculate the portfolio's expected return, then you would use stock 1's portfolio weight x1 times the stock 1's expected return, and x2 times expected return of the second stock. Or if you're talking about realized return, then it's just Rp equals x1 times R1 plus x2 times R2. Second, how does adding stocks to a portfolio affect the efficient frontier? This one is from the lecture note, and there were several pages discussed about this. So basically, if you could recall, if you have fewer stocks, let's say the efficient frontier looks like this with fewer stocks. Now, if you have more stocks, then the efficient frontier will actually move to the left. Right? So this is the direction of the movement. It will move to the left. The intuition is if you compare the efficient frontier on this left-hand side versus the efficient frontier on the right-hand side, right? What you can see here is for this curve, right? It has if you fix volatility, if you fix risk, then the portfolios on this left curve, they have higher return. Or if you fix return, then portfolios on this left curve, they have smaller volatility, right? To see this, you just need to draw some lines, right? So if you compare these two portfolios, you can see that the one on the left-hand side has lower risk or lower volatility. Or you could draw a line like this. Then you would see that the top portfolio and the bottom portfolio, they have the same volatility. However, the top portfolio has a larger return. The third question, what is the efficient frontier? So it's the curve or it's the frontier of efficient portfolios, right? Very simple. What is Sharpe ratio and what does it measure? So Sharpe ratio, at least according to our lecture note, is defined by expected return of your portfolio minus risk-free rate divided by divided by standard deviation of your portfolio. So it's a measure of the reward to risk ratio, right? So this is your reward because you're making some investment. So you do want some returns back as your reward. And this is risk because we know that standard deviation is a measure of risk. Fifth, how does beta affect an investment's cost of capital? Well, this is basically about the capital asset pricing model, right? So we know that investment I's cost of capital equals risk-free rate plus beta I times the market expected return minus risk-free rate. So basically, if beta increases, then expected return or the cost of capital, they will increase. Here you might wonder why expected return is also the cost of capital? Well, because these two things are actually the same. They have different names, just from different perspectives. If you're a firm, right, then you will care about cost of capital. If you're the investor, then you will care about the expected return. However, these things are the same. Sixth, is the market portfolio efficient? Justify your answer. Well, this is sort of a long argument, right? First, it is efficient under those three assumptions listed in the lecture note. And the justification is basically it's about supply equals demand. Supply is the market portfolio. Demand is the aggregated. Demand is the total, the sum of all individual investors' portfolio. And because under those three assumptions, each individual is holding the same efficient portfolio. So the aggregated portfolio or the sum of their portfolios is efficient. This implies if supply equals demand, then market portfolio equals the aggregated portfolio. And if aggregated portfolio is efficient, then market portfolio is efficient. Right? So that's the argument here. How are the capital market line and the security market line similar? How are they different? So both of these two lines are expressing expected returns using some pictures. And for capital market line, the horizontal axis is different from the horizontal axis of the security market line. So let's compare these two pictures here. Right? So for this capital market line, you can see that the horizontal axis is volatility. And for security market line, the horizontal axis is beta. Right? So basically, security market line is the line about expected return and beta, and as capital market line is the line about expected return and volatility. And I would also want to remind you that if CAPM holds, all securities returns should lie on the security market line. Okay, that's great. So now let's move to the next chapter, which is chapter 3. It is about the implementation of CAPM. That is, how do you actually use CAPM? So this comes from the first half of chapter 12. So let's first talk about the market portfolio, right? First, what's the definition of this guy? We know that market portfolio refers to the portfolio containing all securities in the market. It looks like this is a clear definition, but it seems that it's not that practical, right? Because if you want to actually use market portfolio, it seems that you have to find out or look for all securities in the market. That is a big task. So we want to simplify our life. Right? So we will want to use some proxies for this market portfolio. So basically you can see that market proxy is basically a approximation to the market portfolio. Now, what kind of market proxy we would want to use? We will want to use market index. Market index is essentially a collection of different securities. Of course, it's important to know what kind of market index we would want to use. So for this Canadian market portfolio, we could use this TSX Composite Index, which is essentially the portfolio of stocks of the largest firms on the Toronto Stock Exchange. For the US market, we could use SP 500, right? So we could use this portfolio to represent the US market index. And SP 500 is the portfolio of 500 of the largest US stocks. So to give you a more intuitive understanding of this market index, we could basically look at these so-called market indexes, right? You can see that it's this actual index, right? So we can see that this SP 500 index today has a value of 3,307.15, right? And you could also use Wikipedia to get more understanding about this market index. And you can see that it's a index of large firms, right? So 500 large firms. The same thing for TSX Composite. So you can see that again, you can see the price, the return, and press the Wikipedia, you would see that it's the benchmark Canadian index representing 70% of total market cap from the Toronto Stock Exchange with about 250 firms, right? So this gives you this more close look at these so-called market indexes. Okay, so after understanding, we could use market indexes to represent market portfolio. Now we wanted to go back our old question, that is, how do you calculate cost of capital? And you know that the answer is, well, we could use CAPM, right? But CAPM is a formula. It's still very abstract, right? So if you look at this guy, obviously you have to figure out its different components, right? So what is RF? Yeah, we know it's risk-free rate. But what exactly is a risk-free rate? Should I use 1%, 2%, or 3%, right? And what about this guy? It's an expected return on the market. How do you get this expected return, right? So clearly we have assumed we could use market index to represent market portfolio. So basically here, the expected return of the market portfolio could be represented by the expected return on the market index. But then you would wonder, how do I exactly find out the expected return of market index? Right? So let's answer these questions. So we want to start from this part, right? The market risk premium. So you can see that to figure out the market risk premium, we need to do two things. We need to find out the risk-free rate, and we want to find out how to calculate expected returns. Now, how do you determine the risk-free rate? First, theoretically, the risk-free rate should be the risk-free rate at which investors can both borrow and save at your investment horizon. The meaning of this statement is like this. Let's say you have a project which spans 10 years. In this case, you should look at a risk-free rate which corresponds to 10-year risk-free rate. Now, how do you get 10-year risk-free rate? One potential candidate is you could look at the Canada government bond, right? It's a debt issued by the Canadian government. So it is considered as almost risk-free. So if the 10-year government bond has a yield of 3%, then you could use this 3% to represent your risk-free rate, right? Similarly, if you have a project which spans 3 years, then you could just look at the yield of the 3-year Canada bond. That's the more, I would say, more rigorous approach. But in reality, you can see that if you survey Canadian firms, and if you ask their project managers or their CFOs, how would they determine the risk-free rate, then you can see that most of the firms, they would actually just use long-term government bond, right? So 10 to 30 years to determine the risk-free rate. And sometimes they would actually even use rates from the highest quality corporate bonds. That is, they would use AAA rated bond, right? They would use the yield from AAA rated corporate bond as the risk-free rate. Okay, the second step is about estimate the risk premium or estimate the expected return of the market portfolio. So, the first step of doing this is to use historical data, right? Let's say you're looking at the Canadian market and you're using this TSX composite index as the market portfolio. So you want to estimate the expected return of the market portfolio. What you could do is you would look at, let's say, past 10 years TSX composite index returns. And then you would use past 10 years average return as a estimation of this risk premium. Now, what's the shortcoming of this approach? Well, obviously, historical data are backward looking, right? So your estimation might not represent the future because importantly, we're looking at expected return. So this is about the future return. It's not about the past return, right? So obviously, past return does not necessarily represent future return, right? So that's the drawback of this approach. The second approach is we could use this model-based estimation. So the idea is like this. It's a method based on dividend discount model. Right? So it's based on dividend discount model. This is from your Corporate Finance 1 class. Okay? I think it's from the chapter 8 or chapter 9. What is this dividend discount model about? Well, if you assume there is constant growth, right? Constant growth in dividend, then the stock price equals next period dividend divided by the cost of capital or the equity cost of capital minus the growth rate. This is the idea of using dividend to value stocks. Now we would actually want to do the opposite, right? So we would want to ask, given the stock price and given the dividend, how could we find out this cost of capital here, right? So what we're gonna do is we will formulate or manipulate this formula, and we would change this guy into R equals this, right? What is this? Dividend divided by price. So this is essentially dividend yield. To be more specific, this is the forward dividend yield, right? Because you're using next period dividend, right? And G is just growth rate. So this gives us the idea on how to estimate the expected return of the market, right? So basically, if you could estimate the forward dividend yield of the market and the dividend growth rate of the market, then you could find out the expected return, right? So let's see this example here. Let's say if you're in the US, right, you're trying to estimate the expected return of the S&P 500 index. Let's say this guy has a dividend yield of 2%. Generally, in reality, you could actually get this number. And I would say most of the time, the estimation here, this dividend yield estimation is generally quite accurate because firms' dividend payouts are generally very stable. And we assume that dividends are expected to growth 6 per year. Again, this kind of estimation can be quite accurate. Next, you can see that given these two numbers, right? So we would use 2% plus 6%. This gives us 8%. So now you would consider that the estimated expected return of S&P 500 is 8%. You see that this is quite simple, right? It's basically the forward dividend yield plus the expected growth rate of the dividend payout. Right? Okay, great. Now let's move on to the next task, which is about estimating beta. We know the definition of beta, right? For example, if there's a stock I, and we want to estimate beta I, so what we can do here is covariance of the RI, RP divided the variance of RP. You might wonder, hey, I can just use this formula to find out the beta. Okay, now let me ask you. Okay, let's say this stock I is Apple. Okay, so you want to find out beta of Apple stock. Now, in this case, you have to look for covariance between Apple and the market portfolio and the variance of the market portfolio. So now the question becomes, how could I find out these two numbers, right? In reality, we will not directly calculate covariance and variance. In reality, when you're having historical data, we will use a procedure which is called regression. And because we have not talked about regression, and I believe most of you have not taken econometrics, so I guess most of you have not learned about regression. Basically, if you're interested in regression, if you're from engineering, you could take a machine learning course. If you're from business or economics, you could take this econometrics course, right? Okay, so let's. Okay, so first we will talk about a special case. This special case is actually specifically designed for this course because it's very special. In reality, nobody uses this, but it's good practice if you're just a learner, right? So when there are only two returns, beta is defined by the change of the return of the security due to market risk divided by the change in the return of the market portfolio. And when there are many returns, you would use linear regression. At this stage, these statements may seem vague. So we will look at some practices and clarify things up. I also want to emphasize that you have to be careful with this case with two returns. Beta is defined by the change in the return of the security due to market risk. This is important. Right, this is important. So you can see that Beta is not defined as change in the return of the security divided by the change in the return of the market portfolio. Instead, the numerator is the change in the return due to market risk. That is, we cannot use the raw or return change. We will want to look at this specific component, that is, the change because of market risk. Okay, now let's look at this example, which will help you understand how to calculate beta with just two returns. So here you can see that the market portfolio increases by 47% when the economy is good, declined by 25% when the economy is bad. Now we have two kinds of firms, type S firm, whose return is 40% on average when the economy is good and minus 20% when the economy is weak. And then we have type I firm. And type I firm has only idiosyncratic firm-specific risk. Okay, you might have forgotten what is a type S firm. It's a fictional theoretical types of firm we talk about in first two classes, I think. So basically, type S firm contains only systematic risk. Right? So let me write it down here. So S firm has only systematic risk. Okay, now let's see how could we calculate beta. So beta equals the change in the security return because of systematic risk. And here you can see that the change in the firm's security is 40% minus 20%, divided by 47% minus 25%. Now you can see that the numerator here is the raw change. However, the type S firm contains only systematic risk. So the total change in type S firm's return equals the total change in the return because of systematic risk. So this equals 0.833. Now, type I firm has only firm-specific risk. So it's beta, so beta of type I. Again, the denominator would be the same. It's the change in the market returns. Now, the question is, what is the numerator here? If you think about this a little carefully, you would see that you should put 0 here. The reason is because type I firm contains only firm-specific risk, right? So this implies that the return change because of systematic risk has to be 0, right? Because type I firm has no systematic risk. So the return change is never caused by systematic risk. So the return change due to systematic risk is always 0. So this equals 0. Okay, that's great. So now let's talk about the case of many returns. This is actually a very realistic case. However, as I mentioned, because you're not prepared with econometrics, so we will just briefly talk about these things. So let's say you're looking at a Suncor stock. It's a Canadian firm, so you would use this SP/TSX composite index as the market portfolio. And now you want to understand what is Suncor's beta, right? So to get this initial idea, what you can do is you could actually plot the return of Suncor along with the return of the composite index. So what's this initial impression here? You can see here that so basically the red bar gives you the Suncor's return. And you can see that the magnitude of the return of Sunker stock is larger than the TSX Composite Index, right? This generally means that on a typical day, if TSX increases by 1%, well, maybe Sunker will increase by 2%, right? So this roughly gives you the idea that the beta of Sunker should be relatively large, right? Potentially larger than 1. But how do you precisely find out the value of Sunker's beta? Well, as I said, you have to use regression. So here you can see that you're having a regression line here. This line, this line, right? This line is the regression line, right? It could have many names. In the finance world, it could be called as security characteristic line. In econometrics, it's the regression line or fitted line. And in machine learning, it could be called with, it could have the name disease boundary. But let's forget these fancy names. Let's just say this line, this straight line, will actually give you beta. So here, beta is the slope of this regression line, right? And of course, beta is the measure of the market or systematic risk. And you can see that this picture is somewhat interesting because it also tells you what's the idiosyncratic risk or the firm-specific risk. So if you look at, let me see which point I want to use. Okay, I'll use this point because it is somewhat isolated. So it's easier for drawing some lines around this point. So let's say we're looking at this. Oops, that's weird. So let's say we're looking at this line. Sorry, we're looking at this point. And then the distance between this point and this regression line gives you firm-specific risk. Sorry. More accurately, this distance gives you the return due to firm-specific risk. That's the more accurate statement because the vertical axis is about returns. And now this portion, right? It is the return due to systematic risk. Systematic risk. So basically, you can see that this line has this decomposition effect, right? It decomposes the raw return into two components due to firm-specific risk and due to systematic risk. I could understand that this might seem a little vague to you. If you want to know exactly why, well, take a econometric course. Okay. Oh, sorry. The takeaway of this picture is really this statement here. Beta equals the slope of this line, right? That's the takeaway from this picture. Okay, so in more practical terms, right? How do you find beta? First, you would use linear regression, and basically you would get a bunch of data, and then you would use some software to find out what is the beta here. If you're from business, then most likely you would use Excel. If you're from economics department, most likely you will use Stata. If you're from statistics department, most likely you will use R. If you're from engineering department, most likely you will use Python. Right? And a simple way to figure out beta is to use Excel's slope function. Okay, great. Now let's review this chapter. You can see that this is a small chapter. We basically talk about how to actually implement Comparative, right? That is, how do we actually find out what kind of risk-free rate we want to use? And how do we actually find out what kind of, or how do we get the expected return of the market portfolio? And finally, how could we actually find out the value of beta, right? Okay, now let's see the two questions which help to review this chapter. How can you estimate the market risk premium? There are basically two ways, right? The first, you could look at past historical data and you could calculate average market returns. And in this case, you would know that if the past return can give you the accurate estimation of the future, then you could use the past average return data. But we know that that is not very realistic. So maybe we want to use some forward-looking measures. In this case, we will use this formula inspired by this constant growth dividend discount model, right? That is, the expected return equals, I actually should put expectation here. So the expected return equals the next period dividend divided by today's price plus G, right? So now in this case, market risk premium becomes simple. It's just a very simple decomposition, right? You have two components, dividend yield plus the growth rate. Second, how can you estimate a stock's beta from historical returns? So as I said, you will have to use a statistical process, which is called linear regression. And to learn about this, you have to take a course in econometrics if you're in business and economics, or a course in classical machine learning if you're in engineering. And so using this linear regression, we could fit a line which is called the security characteristic line. And the slope of that line is beta, right? Okay, that's great. Now let's move on to the fourth chapter. So fourth chapter is like the, I would say the end result, the purpose of the previous three chapters. Remember that we have done a lot of things, right? We talked about how to calculate the expected return, how to calculate the average return, how to calculate the standard deviation and variance, and then we talk about efficient portfolios and the volatility of a portfolio, and then we introduce the Comparative. Right? What's the purpose? The purpose is always about calculating the cost of capital, because this is a corporate finance class, right? A really important goal of corporate finance is to think about the project investment. When you're thinking about project investment, you have to do some project evaluation. And then the very fundamental project evaluation metric is the net present value, right? And to calculate net present value, you have to find out cost of capital. And in Corporate Finance 1, when there were no risks, then you would basically just use risk-free rate as the cost of capital. But when the project has risk, and generally in reality, almost all projects have risks, right? So in this case, how do you accurately predict, estimate your cost of capital with project risk? This is an important task, right? So that's why we learn about CAPM, because it helps you to find out the cost of capital when the projects have risk. Okay. Now let's first discuss how to calculate the equity cost of capital. Why do we do this? Well, because generally your project at the partially will be financed by equity, right? Just to think about public firms, right? If you look at the financial structure of Apple, Google, Amazon, or any major firms, then you can see that it contains both equity and debt. So if you want to estimate the total cost of capital, then the first step is to understand how to calculate the equity cost of capital and the debt cost of capital. Right? So here we start from the equity cost of capital. Okay, the formula we will use, as I have said, is CAPM, right? So basically you can see that the equity cost of capital can be calculated by this formula. Oops. Okay, now let's see this example here. Suppose you estimate that Google's stock has a volatility of 26% and a beta of 1.45. And UPS has a volatility of 37% and a beta of 0.79. Which stock carries more total risk? Which has more market risk? Now, if the risk-free rate is 3% and you find out the market expected return is 8%, then what is the equity cost of capital for Google and UPS? Which firm has higher cost of equity capital? So now let's first answer the first question. Which stock carries more total risk? First, you have to understand what is the measure of a total risk. It's volatility, right? And here you can see that Google has a volatility of 26 and UPS has a volatility of 37%. So the answer to the first question is UPS has larger total risk. Second, which has more market or systematic risk? We know beta is a measure of systematic risk. And here Google has a beta of 1.45. So the answer to the second question is Google. Third, which firm has a higher cost of equity capital? To answer this, we have to calculate the equity cost of capital for Google and UPS. So the cost of capital for Google equals the risk-free rate, 3%, plus beta times the market return minus risk-free rate. So similarly for UPS, 3% plus 0.79, 8% minus 3%, which gives us so 10.25 and 6.95%. Now, which firm has higher cost of equity capital? Obviously Google, right? You can see that this is not surprising. If you compare the calculation of Google's equity cost of capital and the UPS's equity cost of capital, you can see this. That is, the only difference here is beta, right? So whichever has higher beta implies whichever has higher equity cost of capital, right? And Google has higher beta, so definitely Google will have higher cost of equity capital. Okay, second, let's see how could we calculate the debt cost of capital. The first way of calculating debt cost of capital is using yield. So first, you need to understand what is yield. So yield is a short term for yield to maturity. It's essentially the internal rate of return a debt holder will earn from holding the bond to maturity and receiving its promised payment. Right? Let me give you a simple example. Let's say you have a zero coupon bond. Let's say this zero coupon bond has a face value of 1,000. Let's say this is a 1 year zero coupon bond, right? By the way, zero coupon bond basically means the bond does not pay you any coupon payments. You will just get this final par value on this maturity date, right? And let's say the 1 year zero coupon bond has a par value of 1,000, and let's say it's today's price is 900, right? Now, what is this bond yield? Well, let's see how can you find this bond yield. If you look at this definition, it says yield is the internal rate of return an investor will earn from holding its bond to maturity and receiving its promised payments. So the key here is it's the internal rate of return, which means if you discount this $1,000 by this yield, then you should have $900, right? That's how you define the internal rate of return. So yield is given by this guy here, right? Essentially, bond yield is just a discount factor. So it's a discount factor which makes the present value of coupon payments and par value equal to the bond price, right? That's the definition of the yield. Now, the question is, what's the relationship between the yield and the expected return of the bond, right? Let's say if the bond has a yield of 10%, does not imply the expected return of the bond is 10%. Well, not necessarily. Here, if the bond does not default, then in the end, the expected return will be 10%. But if the bond defaults, then the yield will be larger than expected return. So now our task is basically considering the effect of firm default and find out what's the relationship between yield and expected return, right? Okay, now let's see this calculation here. Let's say you're having a 1 year bond. This bond has a yield of Y. However, potentially, this firm will default. So, with probability 1 minus P, right? Okay, maybe let me just write it here. So you have yield of Y. And there are two cases. With probability 1 minus P, there's no default, right? So no default. In this case, if you invest $1, you will get 1 plus Y dollars. So in this case, your return equals yield because there's no default, right? With probability P, there is default. In this case, you cannot realize this promised yield, right? You will actually suffer from some loss. Let's say this loss is given by L. What is this L? This L is the expected loss rate, right? So L is the expected loss rate, which is the per $1 of debt, L is the expected loss rate, which is the expected loss per $1 of debt if there is default, right? Now, what is your expected return? This is very simple, right? So the expected return from holding this bond is when there is no default plus when there is default, right? So this gives you y minus p, oops. So this gives you y minus pl. So it's the exact formula here. Oh, sorry. Oops. So the app just crashed. Okay. So you have this, right? So it's exactly the formula here. And you can see that it does make sense, right? So it basically means that the expected return from this bond is the yield minus the probability of the default times the expected loss rate, right? It basically means that if there is a higher probability of default, or if the loss is larger in the event of default, then the expected return of the bond will be lower, right? Okay, now let's see. Here we have some data here. It's about this annual default rates by debt rating. I think this is for the U.S. market. Yeah, it should be for the U.S. firms. So you can see that even during average times, right, the highest rated debt has almost 0% default rate, and this low CCC rated debt has this 12.9%. And here you can see that this difference will be magnified if there is recession. In recessions, the default risk for AA is still very low. It is still almost 0%. But you can see that for this CCC minus, right? For this rated debt, it increases to 79%, which is just ridiculous. Think about it. It means that almost 80% of CCC minus rated debt will be in default, right? This is like very high default rate. Another thing you could see from this table is you can see this different rating categories, right? So you could see that the highest rated firm would get AAA rating. Then the second would be AA and this single letter A. And then you will go into BBB, BBB, and then lower CCC and CCC minus. Right? Okay. Now let's see this example here. So this example is about return versus yield. That is the difference between the expected return and the yield. So let's assume the loss rate for debt is 60%. So here we wanted to calculate expected return from the yield, right? So according to the formula, the expected loss rate is 60%. Now, what is the P here? P is the probability of default, right? So let's say we're interested in the B-rated bond at average time, right? So we check this table, and we find out in average time for B-rated bond, its default rate is 5.2%. So you can see that here I would use 5.2%. So this gives us y minus 31%. So this basically means that if you compare the expected return and the yield, then you can see that for B-rated bond, during average times, the promised the expected return should be 3.1% lower compared with the promised yield Y. Now let's talk about the second way of calculating the cost of debt. Well, this one is easy because we could just use CAPM, right? We could use, pretty much similar to calculating the equity cost of capital. We could calculate the debt cost of capital using CAPM. But the only caveat here is about beta. So when you're calculating equity cost of capital, you will use that firm's beta, right? Let's say if you want to calculate, let's say Apple's equity cost of capital, you would use Apple's beta, right? How do you find out Apple's beta? You would just look at some historical data of Apple stock returns. And then you will use Apple stock returns and SP 500 returns. And then you will do a linear regression. You could find out beta. But you cannot do this with debt because bank loans and many firms' debt, their corporate bonds, are traded very infrequently, which means we cannot get reliable data for the returns of individual debt, right? Remember that to find out beta, you always need individual securities returns. So if you cannot find reliable debt returns, then you should not use the simple linear regression to obtain that debt's beta, right? So what's the solution here? Well, we will just approximate the firm's data. We will just approximate the firm's data beta, right? By using the estimates of betas of bond indexes by rating agencies. Now, what does this imply is, let's say you're thinking about estimating Apple's AA rated debt. You want to find out this debt and what is this debt's beta, right? What is its beta here? Now what you do is you will look at a bond index. Let's say we have a index of all AA rated debts, right? That is, this index is a portfolio. It contains all AA rated debts from different firms, right? So this is a portfolio of AA rated debt from Microsoft, from Google, from Lululemon, from Nvidia, right? So in this case, after getting this bond index, you will calculate this index beta. So you will use this index beta as beta for this firm's AA rated debt. Right? That's the idea here. Okay, now let's see some data here. So this is from Stanford GSB working paper 2009. So it's basically a estimation of debt categories beta. So you can see that the first or the top panel gives you the result by ratings, right? So you have these different ratings and you have their betas. Or you could also have the result by maturity. However, this is only a table for higher rated debts, right? So you have to, so this is for BBB and above. That is for these guys and these guys. Okay, great. Now let's see this example here. So in middle 2009, home builder. KB Home had outstanding 6-year bonds with a yield of 8.5% with a rating of BB. If risk-free rate is 3% and the market risk premium is 5%, estimate the expected return of KB's debt. So here we have basically both. We have basically both risk-free rate, market risk premium, and maturity. So this implies we could actually calculate the expected return using two methods we have just learned. So let's start with the first one, right? The first one is about we could adjust yield, and by considering the probability of default and expected loss rate, and then we could find out the expected return. So R equals Y minus P times L. So what is Y here? Y is the yield, so it's 8.5%. What is P? So we will look at this annual default rate, right? So we will look at this annual default rate. And here you can see that according to this table, in average times, a BB rated debt has a default rate of 2.1%. In recession, you will have 8%. And June 2009 is the last month of the last recession. So here we will use 8%. In your exam, you don't really need to care about whether this is in recession or not, because if a table like this will be used, I will just tell you what is or whether it's in recession time or in non-recession time. So here we will use the probability of the default rates under recession. So it's 8%. Now let's assume a expected loss rate of 60%. So this gives us 37%. Oh, by the way, you might wonder, how do I know the last or how do I know June 2009 was the last month of the recession? So for recession related data, you could check NBER recession, right? So NBER is like the official institute to determine the time, the year, and the month of different recessions. So you can see that you have all the recession here, right? So we are still in this recession, which started in February 2020. But for the last recession, you can see that for the peak to trough, the peak was December 2007 and the trough was June 2009, right? So basically the 2009 June was the last month for this last recession. Okay, that's just for some sort of common sense, right? Okay, good. Now let's look at the second way of calculating expected return. We would use CAPM, right? So first let me write down the formula here. So the risk-free rate is given by, okay, so the risk-free rate is 3%. The question is which beta we should use, right? So it's a BB rated bond. And you can see that we should use this. Should we use any number from these columns? Well, we should not, because as I said, this bottom panel is just for BBB and above debt. And the BB rated debt is below BBB rated debt. So you should not use any number from the bottom panel, right? So you should only use this 0.17. So 0.17 times expected return of the market, which is, let's see the problem. So the problem says the market risk premium is 5%. So I have to remind you that market risk premium refers to this whole thing, this difference, right? And expected market return refers to this guy, right? So you have to be careful. And times 5%. This gives us 3.85. So you can see that using two methods, we roughly get this sort of the same answer here. Okay, very good. Now we move on to discuss the project's cost of capital, right? That's our end goal, right? To calculate a project's cost of capital. Now, we start from a simple case. That is, we assume the project is purely equity financed, right? So there is no debt used to finance this project. This would make our life simpler, right? So purely equity financed. Now, let's assume this is a new project, right? And if it's a new project, then there is really no data points for you to estimate its cost of capital, right? Now, how do you get cost of capital for a new project? What it would do is this so-called comparative company analysis, right? So you will look at comparable firms, right? And to be more specific, you will look at comparable firms in the same line of business. Now, if this comparable firm is in the same line as your project, then you could actually obtain data from that comparable firm. Then you could calculate the cost of capital from those data points. And then you could use your calculation, your estimation from this comparable firm as the estimation for your own project. So that's the basic idea here. More specifically, in terms of estimating the cost of capital, so you would use the cost of capital of the comparable firm as a proxy for your project's cost of capital. Okay, let's finish this class with this example. So let's say you want to start a coffee chain or a coffee firm, right? Now you're thinking about how do you estimate the cost of capital for your new coffee firm, right? Obviously, if you're a new guy, you can see that the problem says you just graduated with a MBA, right? So potentially you have never worked in coffee industry. You have no idea how to estimate the cost of capital for your new coffee firm. Now in this case, you will look at a comparable firm, right? So in this case, you're looking at Peet's Coffee and Tea, right? So it's a San Francisco-based coffee firm. Now, in this case, the basic idea is you will use this firm's cost of capital as your project's cost of capital, right? So how do you find out this firm's cost of capital? Well, generally, when you're calculating the cost of capital, you have to consider both the cost of equity and cost of debt. But luckily, we assume this firm has no debt. If the firm has no debt, then the firm's cost of capital equals the firm's cost of equity, right? So basically, you could just directly use CAPM to compute the cost of equity, right? So here, the cost of equity for Peet's Coffee and Tea is given by 3% risk-free rate plus the beta, which is 8.3 times a market risk premium, right? So times 7.15%, which equals 7.15%. So because you're also financing your project with all equity, and then you could just basically use this 7.15% as your project's cost of capital. Right? Okay. One question you might have is how do you get this data? If you look at the problem, it says that checking google.com finance, we find out that Pete has no debt and an estimated beta of 0.87. If you actually do this, first, you will not find Pete's Coffee and Tea. Well, because this firm now is a private firm, if I am correct. But anyway, I know this firm is not listed, so it is not a public firm anymore. Maybe it has been acquired, or maybe it has become a private firm. I'm not sure what happened, but you cannot find Pete's Coffee and Tea in Google Finance.